Welcome to Equity Armor. I'm Joe T. Gay. I'm a former VIX options market maker, S&P 500 options market maker, and I'm currently a portfolio manager on the Rational Equity Armor Fund and the Catalyst Hedged Equity Fund. I help advisors manage the market with less risk. I wanted to do a video today because we're seeing some volatility pick back up. We had Kashkari, the market's least favorite Fed governor, saying, hey, maybe we're still going to raise rates. That really threw the market for a loop, and I think there's one specific reason he's concerned about I want to get into later in the show. But if you like what you see, please like, comment, subscribe. If you want me to do more of these videos, let me know. If you don't like this video, that's fine too. Just dislike it. Just let me know what you don't like. Maybe tell me what you disagree with in the comments. Be happy to check that out and have a discussion about it. But let's get into what I'm seeing, and this is crucial to watch for new investors in volatility, new people watching this. Everyone talks about the VIX index, how critical it is, and of course, it's obviously very critical. But in the recent years with the 0 days to expiration, and in the past few years, and even especially when there's low volatility, this SKEW index is crucial for me to watch. And right now, we're ticking up. It's ticking up in a big way. When people get overzealous on buying these calls, you can see, hey, there could be a big correction coming back in a big way. People need to get out of these calls, cut some deltas, whatever the case is, buy some puts, and the market tends to correct with that. And actually, it has a tendency to be a little bit ahead of the game. Here we are looking at a little bit longer time frame, a 2-year chart. We look at it versus the VIX. Obviously, it's very correlated to the VIX. Looks very similar, but we get a lot of these peaks in the SKEW a little bit ahead of the VIX. And if you look at this last year in this low volatility environment, you're seeing more exaggerating moves in this SKEW index. So it's really telling me something a little bit more. And if you look at it versus the S&P 500, here we are, the S&P 500 in blue. You almost can see this happening in real time, just a little bit ahead of the game. So it's a nice, maybe a leading indicator for me to what I'm watching. Is very crucial for me to follow it. And when you see these trends where it's going down, that's a sign for me, hey, this might be a spot to get into the market. So right now we're trending up. We've broken some resistance. We're making a higher high in the SKEW. So something to be watching out for in the long term, in the short term for the market, and looking at the market in the short term. My base case, even though we had this negative commentary coming from Kashkari today, my base case is that the market is kind of slowing down, but it's still strong enough, and we are getting ready for some rate cuts. And before we actually get these rate cuts, the market has a tendency to do quite well while we have this mixed economy. And really, the market's looking quite strong ever since we started to lower these interest rates back in October. We had a huge rally off of those 5% yields in the 10-year. And then again, we're kind of breaking through this area and kind of going into a new trend line. So this is a really crucial spot for me. I will change my opinion on the market if we do go below that trend line. And in fact, even now we're in this higher trend line. I'll be a lot more cautious if we actually get below this area here. So this is something I'm watching along with the SKEW. I think it would be a very interesting opportunity for me if we see the SKEW index start to trend lower right around when this S&P 500 is getting closer to these trend lines. But the reason I think Kashkari got nervous this morning is because if you go back in time, you look at the recessions, they can either come, because of a stock market crash, it's always possible. But a lot of the time, these recessions are really kicked off because of oil shocks. You go back to, 2007, there actually was an oil shock. A lot of people forget about that. That actually kicked off the housing market bubble crashing, popping. You go back to 1990, oil shock back in the 80s, 70s, again and again. You see these oil shocks starting the recession. That's something that I think the Treasury, Kashkari, is something very worried about this morning. We saw more shelling happening in the Red Sea. This is a time geopolitically when we have two wars with, in major oil producing areas. This oil is a serious problem. And, no matter how much the Fed can cut rates, that'll stimulate the economy. If oil goes higher, that just kind of shoots themselves in the foot. The Fed can't control oil, yet it's actually more important to the economy than these rate cuts would be. The rate cuts are great for people who have debt, but the higher oil hurts everybody. It's just like a tax hike for everybody in the economy. The lower oil will do the opposite. So it's really crucial to keep this oil in check. We got GDP numbers coming tomorrow. We got more inflation data. If the inflation data is hotter, if the economy is hotter, this oil could undo all the Fed's trying to do with these lower expectations and rate cuts. So I think that's what is crucial for the Fed. I'm very nervous about the economy. If we're going to see this oil break out of this downtrend, if the oil is going to bust out to the higher end of this triangle, that would be very bad news for the economy. And of course, the stock market will follow the economy. So again, this is just a very quick video on volatility. If you like what you saw, if you don't like what you saw, let me know. As always, you can go to equityarmorinvestments.com, subscribe to the Ripple Effect newsletter, and have a great trading day. For Equity Armor Investments, I'm Joe Teague.